Hi there. In my undergrad studies, I studied microeconomics, but I didn't like it. I found the big picture focus of macroeconomics very interesting. In recent years, however, I have fallen in love with microeconomics. In particular, I'm fascinated by utility theory and its application to various problems in business and general human interactions. One other concept that I find interesting is the marginal propensity to consume, which has a very interesting application in fiscal policy. This is the subject of our discussion today. Before I continue, however, do visit our website where I curate news and publications from international financial organizations and world central banks. Topics cover a wide range of financial and economic issues that affect individual countries or the world economy. For instance, COVID-19, inflation, or the war in Ukraine. Please also subscribe to this channel and be informed whenever we publish a new video. So, what is the marginal propensity to consume? First, I must explain the word or concept of marginal as it relates to economics. Marginal means the next unit of whatever measurable thing you are considering. For example, the next dollar, or any unit of any currency, or the next unit of cost. In his excellent book, Pricing on Purpose, Ron Baker puts it this way, and I quote, "The value of anything depends on the margin. The margin is what happens next." Marginalism and the subjective theory of value, when combined, allow economists to explain much human behavior. Why are diamonds more expensive than water? Besides being abundant, water tends to be priced based on the marginal satisfaction of the last gallon consumed. The German economist Hermann Heinrich Gossen, who lived between 1810 and 1858, developed what is known as Gossen's law. The market price is always determined by what the last unit of a product is worth to people. The market price of water reflects the last uses of the good for the aggregate of all consumers of water. On the other hand, the marginal satisfaction of one more diamond tends to be very high. If water companies knew you were dehydrated in the desert, they would be able to charge a higher price for those first vital gallons consumed, and then gradually adjust the price downward to reflect the less valuable marginal gallons. Since they do not possess this information, the cost of doing so would be prohibitive. The aggregate market price for water tends to be based on its marginal value." End quote. In mathematical terms, you can visualize a tangent to a graph of a function, for example, a utility function or a cost function. The slope of this tangent is the instantaneous rate of change of y with respect to x. In calculus, this is also the derivative of the function. You may more practically think of marginal cost, marginal revenue, and marginal profit, which are the derivatives of the respective cost, revenue, and profit functions. So, with this background, marginal propensity to consume measures the propensity of an individual or household to consume the next dollar that they get. I should be saying the next dollar of income, but the reason I have chosen to say get will become clear presently. So, if you get the next dollar, how much of it do you spend? Of course, you may also calculate the marginal propensity to save, which measures how much you save of the next dollar you receive. Now, to an individual or household, you probably want to have a high propensity to save and a low propensity to consume. If this is the case, it helps the individual or household accumulate savings. To a government, however, the situation is a bit complex. Suppose a government faced with a severe economic downturn wants to assist its citizens survive the dire economic situation. Suppose also that the government wants to stimulate economic activity to get the economy going. An obvious solution to both problems is helicopter money or helicopter drop, that is, giving citizens checks. If households have a high marginal propensity to consume, then a high proportion of each dollar is going to be spent. And through another allied concept, the multiplier effect, the economy may be kick-started. So, with one policy action, the government can solve both problems. That is, alleviate economic hardship, while at the same time using household spending to get the economy going. In a staff working paper titled Financial Concerns and the Marginal Propensity to Consume in COVID Times, Evidence from UK Survey Data, the Bank of England says, and I quote, "The COVID-19 pandemic has brought renewed interest to understanding how households' consumption and saving respond to income changes. Micro data sets, including timely household survey data and transaction-level data sets from financial budget applications, have allowed economists to estimate the marginal propensity to consume, MPC, out of income shocks quite swiftly during the pandemic. The available evidence points to households mostly saving or paying down debt when receiving a one-off payment during the pandemic. This suggests that typical untargeted direct transfers to the average household may not stimulate aggregate demand as much during pandemics as during other crises. In this context, understanding which household characteristics predict a higher MPC out of income windfalls is of key importance for the design of fiscal support measures. Research during the pandemic has found that the MPC out of positive income shocks is largest for low-income and liquidity-constrained households, and for households who suffered greater income falls relative to their pre-pandemic income. Overall, assessing the response of consumption to income changes is of key importance for the design of fiscal and monetary policies. This is particularly relevant in a fast-changing environment where household expectations play a crucial role in determining how consumption reacts to shocks. In this context, our research suggests that policies that provide support to households who are low income and more vulnerable to becoming financially distressed may prove more effective than providing untargeted stimulus payments to all households." End quote. In practice, the checks that many governments gave to their citizens in response to the hardships of COVID-19-induced economic hardship were arguably a form of helicopter money. As the name suggests, the idea of helicopter money is for the government to figuratively drop money from a helicopter for citizens to collect. This idea was first suggested by Nobel Prize-winning economist Milton Friedman, but in a different context to the one I'm discussing. In a paper, Helicopter Money, What is it and what does it do? Ricardo Reis and Silvana Tenreiro of the London School of Economics say this, and I quote, There is a range of definitions in both the academic literature and in the policy debate. For the sake of clarity, in this paper we define helicopter money broadly as a policy intervention that satisfies two properties. One, it must come with an increase in the liabilities of the central bank, the monetary base. Two, it must directly, holding prices and returns fixed, increase the after-tax nominal income of some private agents. The literature has discussed different channels through which helicopter drops might work. To make sense of them and to compare them to each other requires having a single coherent model. At a minimum, the model needs to have 1. A central bank with a non-trivial balance sheet so that it has something to load the helicopter with. 2. A fiscal authority that regularly makes transfers and issues liabilities, so there is someone effectively piloting the helicopter. 3. Heterogeneity in the private sector, so that different agents may be the recipients of the drops. And 4. Frictions that break monetary neutrality, so that the drops can affect different decisions in the economy. We assume that the role of carrying the money and distributing it is performed by the fiscal authority. It is hard to see how a modern central bank could do this, unless people had deposits at the central bank. Proposals for helicopter drops often do not come in isolation or as a policy to be used at all times. Rather, the drops are proposed as a response to other shocks or to particular challenges that the economy is going through. The pandemic recession in 2020 posed deep challenges to almost every economy in the world. Central banks swiftly cut interest rates, carried out quantitative easing, and resorted to forward guidance on rates. Governments were at this time also increasing transfers in the form of unemployment insurance, payroll protection, and a myriad other programs to households. While monetary and fiscal policy were both following their own independent objectives, by responding to a common shock, their simultaneous actions can be, if added together, stretched into the description of helicopter drops. Their combined actions were not neutral because fiscal policy effectively redistributed resources, both across households and from the future to the present." End quote. As an aside, and drawing a link to the series on money, it is speculated that central bank digital currencies will greatly facilitate helicopter drops. In their recent paper, Central Bank Digital Currencies, An Old Tale with a New Chapter, Michael D. Bordo and William Roberts write, and I quote, "CBDCs might allow for more sophisticated, automated forms of transactions, smart contracts, and facilitate more imaginative forms of monetary policy and quasi-fiscal transfers, helicopter drops." End quote. Commenting on the potential of CBDCs with respect to helicopter money, Reis and Tenreiro in the paper mentioned before say this, and I quote, "A second change that CBDC might make is that it would allow for easy and targeted helicopter drops. The central bank can simply credit those accounts, instantaneously dropping the new money, as opposed to waiting for their distribution as slow fiscal transfers. Moreover, insofar as the new digital accounts have information on their holders, targeting those transfers may also become easier. It becomes feasible for the central bank to pilot the helicopter. At the same time, it is important to note that under their current mandates, the central banks could not decide whether to make those transfers or to target them. The fiscal policy would still need to provide the map and the itinerary to the helicopter pilot, end quote. To conclude, the marginal propensity to consume can be a powerful tool in the hands of the fiscal authorities. But as Reis and Tenreiro conclude in their paper cited before, and I quote, "The general lesson is that the appropriate response to a policy proposal for helicopter money is, tell me more. What form of money, given to who, and with what accompanying policies? These and more make all the difference between this policy being completely neutral or potentially very powerful," end quote.